very easy to have an idea. There are lots of ideas that people have about how to trade financial markets, but there are very few ideas that will actually produce durable alpha over time. People who have been in the investment management business the longest, they are often the most humble because they have recognized time and time again where they've been wrong. For much of my career at Bridgewater, what I was doing was building systematic investment strategies across all the major asset classes, stocks, bonds, currencies, commodities. And what that meant was a combination of working to find new ways in which the company could generate alpha, which means new investment strategies that over time would likely outperform markets and generate returns. And then also, as part of that process, seeing the existing universe of strategies that were being used and wrestling with whether they were capturing the actual dynamics that were going on. Any systematic investment process, is basically there's a sort of a typical way in which you go through the investment process. First, by looking at what you already understand, raising questions about what is not going consistent with your expectations, which then generates a series of questions and new areas for exploration. And then presumably once you understand those areas better, taking that understanding, recodifying it in systematic approaches, then you go back to the beginning of the process. And so really it was about overseeing that overall process. At its core, Bridgewater's approach was what you call fundamental and systematic, which is the basic idea that markets and economies can be best understood. Can be understood through a set of cause-effect rules, and those rules can be, they're somewhat commonsensical in the sense of you could explain the sort of core concept behind those rules to a well-informed person. So you might say, look, if inflation expectations rise relative to where they were before, you're likely to see bond yields rise as a function of that. That's a very simple example of the types of rules, decision rules that we were developing, but gives you a sense as to, the idea. That's a fundamental principle, which is, across countries, across time, when you have that dynamic occur where inflation rises relative to people's expectations, almost always you typically see bond yields rise as well. So it's a fundamental principle, you'd say, a foundational tenet of how markets and economies work and interact with each other. And so that's really what we were focused on. And that sort of was the foundation of the sort of systematic macro approach. And then over time, increasingly started to explore within markets how buyers and sellers were working, because any market is really just a combination of the buyers and the sellers and their motivations. And once you understood who those buyers and sellers were, you could better understand what was likely to happen to the price of financial markets. Creating strategies that over time deliver alpha in markets is very hard. And the best thing to start off with when you're thinking about developing investment strategies is to recognize that you probably don't have edge. People who have been in the investment management business the longest, they are often the most humble because they have recognized time and time again where they've been wrong. And that humility is important because it sets the foundation for durable success. Because if you start with the idea that it's very hard to develop understanding or views in markets that generate alpha over time, and then from there you recognize that you have to, the bar for something being good enough is very high. What it pushes you to do when you're creating these investment approaches is to not just take an idea for granted, but very rigorously explore that idea to see whether or not it's likely to be successful over time, across markets, across different cycles, et cetera. And so that humility sets the foundation for a level of rigor, which is critical to then create the alpha strategies that and the edge that's necessary to manage money over time. The first one is the power of systemization, and in particular, to give yourself the space to not just focus on what you need to know and what's coming at you and processing it, but having that foundation, basically having a foundation in place which reflects well what you already understand today, to then allow yourself to spend most of your time exploring what you don't know or the new incremental questions. So systemization, very important. The process of exploration, the rigor in exploration, I think, is probably the second thing that is most important about what I learned through that process, which is it's very easy to have an idea. There are lots of ideas that people have about how to trade financial markets, but there are very few ideas that will actually produce durable alpha over time. And so what you have to have is bring that level of rigor and a constant questioning of saying, do you really think that what you've developed makes sense, works, will work through time, et cetera? And by creating that level of rigor, what it allows you to do, you're going to fail a lot in that process. Even the best ideas, a 300 batting average will get you into the Hall of Fame, and way less than 300. 30% of your investment ideas are likely to meet the sort of standards that's necessary to bet on them. And so, you have to have that recognition that you want to have a very high bar in order to be successful. And I think the last thing that was really valuable in terms of that experience is the discipline, learning about the discipline necessary to manage money effectively. Part of being a great asset manager is creating edge. But creating edge is a lot easier. It's not easy, but it's a lot easier than executing on edge. And the way that you're successful as an asset manager is not just create the good ideas, but execute them well and efficiently and as often as you possibly can. And the way you do that is with the discipline to follow your edge. So often, as an asset manager, you're getting all sorts of information. You might think that you want to bet on one particular, bet on something that isn't necessarily in your wheelhouse of your edge through time. And those are the sorts of things that degrade your alpha and degrade your ability to generate high quality returns over time. And so part of the story is recognizing that is the biggest risk to your edge, is a lack of discipline. And so having the rules and approaches in place to do that, to trade your edge as effectively as possible. For instance, risk controls and ensuring that you're not, overweighing one particular bet through time. Systemization is extremely beneficial along that dimension because what you're doing is it's essentially embedded discipline using rules-based decision making, and ultimately humility to recognize there's a lot that you don't know about what's going on in the financial markets and in the global macroeconomy, and as a result, having that lens in your mind whenever you're approaching any investment problem. When I was creating proprietary investment strategies, I think the core edge that I was able to develop over time was that deep understanding of how the macroeconomy and asset markets interacted with each other, and being able to translate the theories and concepts about how they interact with each other to quantifiable systematic approaches that then could trade markets on a day-to-day basis. And so, the real edge there was that depth of understanding. I think in part of the real alpha there was what I'd call slow alpha or slower alpha, where there's always a desire, an increasing desire as we, are on social media and everyone's looking at every tick and Bloomberg and et cetera is reporting every tick of every market move to try and catch every single market move that's happening. And so people get very myopic on the day-to-day incremental market moves. And what that means is that there's actually a lot of opportunity, increasing opportunity for slow alpha rather than fast alpha, where positioning or thinking or understanding how markets are likely to move over the course of 3, 6, 9, 12 months is an area that is under focused on, increasingly so in the market. And so if you can bring that systematic discipline to an area that has a lot of alpha opportunities, that's really where an edge gets developed. Any investment research team has to be a combination of the creation of new insights, the exploration of those insights into whether or not they can be used to generate alpha, to trade markets, and then the actual execution of that effectively. And so often people will not see that it's bringing together all three different parts of those pieces that are necessary to be able to contribute to building an asset management business over time. And what's important to recognize in that is that different people are good at different skills along that dimension. The person who is maybe good at identifying new insights may not be the best person to do the analytical work necessary to test those insights to see whether or not they're good at trading markets or operating it on a day-to-day basis. Different people with different skill sets that you have to bring together. And then the key thing to layer on top of that is to create a culture where you're in a culture of innovation, right? Ultimately, asset management is an innovation business. And so in an innovation business, it's critical to create a culture where pushing the boundaries of existing thinking is highly rewarded, even when it's wrong a lot. Because you don't need, just resting on your laurels and what you already know isn't going to allow you to innovate. What's going to allow you to innovate is thinking about and pushing the next idea and the next idea, the things that you hadn't thought of. And so in order to do that effectively, you really do have to create that culture of innovation and supportive innovation in order to get the best ideas out of the group that you're managing. One of the things I really learned from Ray Dalio was his focus on systemization, particularly in thinking about it from the macro space. I think in terms of sort of interacting with him and seeing his investment process on a day-to-day basis, I think probably the other thing that was really valuable to see was how important it was to work at a bunch of different levels when you're thinking about developing insight or thinking about how what's going to play out in markets or economies. Everything from a big picture, what are these, what's the 100-year trend that's going on, all the way down to which banks have which amount of capital and which assets and are likely to experience losses and be squeezed, right? Being able to move at all those different levels is necessary to be able to generate that insight into what's likely to transpire in markets. And so, at his best, he was very good at working at all those different levels. And so, that's the sort of thing that I think often people will look at, the ability to sort of move between levels. People will look at that and they'll say that there's innate skill in that. And there's certainly, some people with more aptitude and less aptitude, but it's also part of the way to do that is to have the discipline and the whole and holding yourself accountable to create the habit of working at the very high level all the way down to the granular and then all the way back up, building that habit, that way of thinking on a day-to-day basis. A big part of my experience at Bridgewater really set the foundation for thinking systematically about investment problems in general. And in particular, as I've turned my attention to Unlimited, thinking about how do you build in this case, systematic replication. So instead of building systematic proprietary strategies, what I'm doing is looking over the shoulder of how asset managers are positioned in close to real time and creating a systematic approach to infer how they're positioned. Well, a lot of the techniques, while the specific goal is a little bit different, a lot of the techniques that I'm using in terms of approaches to building systematic investment processes, the toolkit is very similar. And so that's probably the most direct translation from my time at Bridgewater building proprietary strategies to what I'm doing today. The key question whenever you're thinking about any investment opportunity is to recognize that the price of asset markets at any point in time reflects the collective wisdom of all the market participants. Simply saying that a certain outcome will occur does not necessarily mean that you have a good investment opportunity. So to give an example, just because you think, say, growth in the US is going to be stronger, is going to be stronger ahead, doesn't necessarily mean that you want to be buying stocks. And the reason why that is that if everyone who's participating in the market on average thinks that growth is going to be stronger in the future, that's already reflected in the asset price. And so one of the key ways to develop, the key foundation of any good investment strategy or insight is recognizing the divergence between what's priced into asset markets and what is likely to transpire. What we call a non-consensus view is a foundational tenet of any good investment view. And so from that point, looking at the difference between what's priced into markets and what you think is likely to transpire that's different in the future, that gap creates the investment opportunity. So say everyone in the equity market, on average is thinking that growth is going to be very strong, but for a fundamental macro reason, you believe that growth is likely to be weaker than what's currently expected in the market. That the opportunity is the gap between those two things. And all too often, investors will focus on what they think is likely to transpire in the future and the momentum of that view much more so than they'll think about what the difference is between what's priced in and what's likely to transpire. And sometimes what that means is that the best opportunities aren't necessarily the most highly probable opportunities, but instead the best opportunities are the ones that are most inadequately priced into financial markets. A big focus of mine early in my career was leading Bridgewater's research around the global financial crisis and the risks around that. And a big part of my work was understanding what credit risks existed for banks and other financial intermediaries at the time, based upon the buildup in the mortgage boom and the housing boom that occurred in '06 to around '06. And so that was a great opportunity to think about when you were looking at market pricing at the time. Markets were pricing in, particularly for these various securities, essentially no chance that these securities would ever incur a loss. There's essentially no chance that homeowners would ever default on their mortgages. And at the time, what we could see in the data was that there was an increasing frequency of people who were borrowing. There's an increasing frequency in which they weren't able to keep up with their payments, and there were triggers ahead that would cause their payments to rise, which would make them even more challenged in continuing to pay off their mortgages. And so that sets up the sort of opportunity that's very interesting from an investor's perspective, which is the market pricing, for a variety of reasons, was essentially pricing in little to no default risk in these securities, when the macroeconomic dynamics were highlighting that there was a substantially increasing risk of those mortgages defaulting. And that gap, and where that gap would translate who would be affected by that gap, created the investment opportunities at the time. I always like to talk about my some of my first trading early in my career, because I'd say I was very fortunate to learn that there was a lot I didn't know about markets. So early in my career, I started trading natural gas, and the reason why I started trading natural gas is because it was very volatile. It had the opportunity to make significant amounts of money in a very short period of time because of its volatility. And when I started trading natural gas, I was betting on prices to go higher, and that happened for a short period of time, and I became increasingly confident that that was the case, and that would extend into the future. And then, of course, the market reversed just as I was increasing my positions in it, and basically wiped out my first year bonus as an investor. And when I look back at that time, I was talking to people about this natural gas trade and how challenging it was. And people asked me, why did you think natural gas was going to, go in one direction or another? And the answer was pretty weak in terms of what I knew about the natural gas market. It was a good lesson learned. The loss of money is always a good lesson learned in the markets, of the fact that this was not an easy business. And there were lots of people out there, experts every day, coming in and trading that market. And I was not an expert in natural gas and continue not to be an expert in natural gas. And so just thinking that, I could follow a price trend or have a speculation that prices were going to go higher, or maybe I thought that, the weather was going to be a bit colder than what was happening previously. Like, that is so far away from what's good enough to be a great investor and to put money on the line. And fortunately, learn that lesson, in big size early, and got humility related to what it took to actually have edge, that I carry with me even today.